This is a lecture from Open Tuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
Chattels is a very specific part of the capital gains tax computation, and in the TX exam you are likely to get one of these. It has some unusual rules, and basically those rules need to be applied to given situations. So what we're going to do, as always, we'll go through the rules and then I will show you in an example how that works in reality. So a chattel is described as a tangible, movable asset. So a wasting chattel is one that has a life of 50 years or less. Now, we're talking here racehorses, greyhounds, dogs, yachts. That's because over the years, what is and what isn't a chattel has been challenged through the law. Thankfully, you don't have to know what those laws are and what has been challenged. You just need to be aware of what a wasting chattel and a non-wasting chattel is. So a non-wasting chattel is one that has an estimated life of less than 50 years. So includes antiques and paintings. And we are going to look at the anti-avoidance rules for those. So these are the rules. If everything, the cost that you received when you sold it and the proceeds, the cost when you bought it, and the proceeds when you sold it are below 6,000, it's exempt. Now that means that the majority of individuals in the UK never pay capital gains tax on any of their assets because most of the assets that we own individually are below that limit. Houses are exempt from capital gains tax. Cars are exempt from capital gains tax. So most of the things that we own as individuals, most individuals in the UK never pay capital gains tax because of these rules. So that's the first one to remember. The second one to remember, which is the easy one, everything over 6, it's not a chattel. It's not classed as a chattel. And you do the normal computation, which is proceeds less cost equals gain. Now, we have two situations here. One, where the proceeds are bigger than 6. So say the proceeds are 8. And the cost is less than 6, and we'll go for 4. Which means we made a gain of 4. In that case, you do a normal calculation. However, you restrict that gain and do the gross proceeds, which is 8, and you use 6,000 as the deemed cost, and you multiply that by 5/3. And yes, you do have to learn that rule. Now, why would they give you that? Why would they remove some of the gain which they would expect to be taxable? And it's because of the second rule, where we have proceeds of, say, 4 and cost of, say, 8. In other words, we've made a loss. These anti-avoidance legislation rules are to stop you from making incidental losses, because you could sell things that you know are more valuable for less than they are worth and therefore make loss. The rule for losses in the current year, that loss must be set off against gains in the current year, and you might have one whopping great gain. So we've got now 5 losses against 1 gain. So they're trying to restrict this loss-making situation. So that you then reduce the amount of tax that you pay, they get less tax. So then if that's the case, you have to change that figure to 6, and that reduces the loss to 2. So having fiddled with, so to speak, and that's not the technical tax term, but you know what I mean, a loss situation, they've balanced that out with fairness by saying, well, okay, that's the situation. You won't have to pay as much tax on any gains that you make on chattels. So let's have a look at example number 9. And we've got John here who's selling rather a lot of assets, 4 of them. Okay, so first thing you need to do with anything, if you get a list like this, is to find anything that's exempt. So we've got an antique table, a painting, a vase, and, oops, a car. That is exempt. Do not ignore. Tell the examiner and the marker you know that that is exempt. So let's have a look at these ones individually. The table, cost 3, sold for 5. Okay, cost 3, sold for 5. Now, this is an exempt asset because, why? Because both the cost and the proceeds are less than £6,000. Again, explain it is exempt, and it's exempt for a different reason. It's exempt because the proceeds are less than 6. So the car is exempt because it's specifically exempted in law, and the table is exempt because all the proceeds and the costs were below 6. So you're going to get marks for explaining that that's exempt and that's exempt and why. So please do. So we're then left with a painting that cost 2 and was sold for 10. So that would be 10 minus 2, which would be 8. Okay. So that's that one. So we've done the D, that's exempt, that's exempt. We've done the painting. The vase, cost 8, sold for 3. So in normality, that would look like that. And if in doubt, and you can't remember the chattel rules, do proceeds less cost equals gain, because that's half of the job. Because then while you're doing that, you might think, oh, I can remember this vaguely rings a bell, and then come back to it if you don't, and if not, leave it. There are going to be bits in this exam that you can't do. Okay, you have to accept that fact and do as much as you can. You're after getting more than 50 marks. Okay, you will not be able to do everything. So that's the normal calculation, but because this is a loss, we need to bring in the rules, and if we do that, then this is the deemed proceeds and the actual cost. So the loss is therefore restricted to that. So that's the restricted loss. Now, just going back to this, we need to multiply that by 5/3. So that's the normal calculation. Okay, let's just rub that out because I made a slight error there. Please forgive. Okay, let's get rid of that. Okay, let's reiterate that again. So this is the normal calculation for the painting. We sold it for 10. It cost us 2. That's our normal calculation. What we need to do is the 5/3 calculation, where we put in the deemed figure. Okay, so this is deemed. If I move it that way, I can get the word in there. Of 6. And we multiply that by 5/3, which comes to 6,667. Now, on this side, with the loss, you don't have a choice. Okay, it is restricted to that too. However, on this side, you do have a choice. Do you want to pay tax on 8, or do you want to pay tax on 6,667? I think you'd rather pay tax on 6,667. So in this situation we have here, A, there is nothing. B, we have 6,667. C, we have a loss of 2. And D, okay, let's bring that back. We have nothing. So that is 4667, and that will be covered by A, E, A. So one last bit in this section is other wasting assets that are not chattels. Now this is a rare exam question. It's unlikely you will get anything along these lines. Now, instead of doing A over A plus B or any of the other various different things, we have to deal with the allowable expenditure wasting away over the life of the asset on a straight line basis. So it would waste away like that if I was doing a graph. So when a disposal is made, the allowable expenditure is restricted to take account of the asset's natural fall in value. This fall in value is deemed to occur on a straight line basis over its predictable useful life. And this is the calculation that you would use. And again, this is rare. You must be able to do capital gains tax, you must be able to do part disposals, you must be able to do chattels, you must be able to deal with losses and all the tax consequences and the income tax position. When you can do all of those, and only then do you look at this. Okay, it's a more complex thing, and I don't want you wasting time doing this when you could be learning the things that are likely to come up. So P is the period of ownership of the seller, L is the predictable life of the asset, C is the cost of the asset, and S is the scrap or residual value at the end. Let's do a quick example. So on the 1st of December, Zahia bought a copyright for 25,000. So that is our cost. Estimated useful life is 30 years. An estimated residual value is £1,000, and it was sold for £38,000. Okay, so first things first, we know what the proceeds are. They are £38,000. Now we have to deal with cost, because that's obviously the working that we're going to have to do. So we are going to deal with the cost, which is 25,000, and we're going to reduce it over its straight line basis over its life using P over L times C times S. So you would write that out in the exam, please. And then P is the period of ownership, which is 12 years. From the question, we worked that out over 30 years times the cost of the asset, which was 25,000, less the residual value. What I'd like you to do now is just to pause this and work that out for yourself. Okay, it's very easy for you to just 12 over 30 times 24, and you'll just take my answer for it. But in the exam, I won't be there. You'll need to do it yourself. So just pause, do the maths, see if you come up with the same answer. And the answer you should come up with is 15,000. Sorry, that's the answer. 9,600. That's what the answer to that is, giving us 15,400 as our cost applicable to this at the time, because it has diminished or wasted over its lifetime, giving us a gain of £22,600. Okay, so go through that again, make sure that you are aware of it, maybe read it in your BPP manual, but then please don't waste a lot of time trying to remember everything. The other things are more important.